What if I told you there's a simple approach to investing that doesn't require complex formulas and removes the effort and risk involved in trying to pick the best stocks, as well as it outperforms a majority of retail and professional investors, and if you invest in it consistently over the long term, eventually it'll turn you into a millionaire. It sounds crazy, but once you understand it, it's fairly simple, and it's called the 3-fund portfolio. And in this video, we're going to go into detail on what this strategy is, along with the benefits and how to create your own 3-fund portfolio. So let's jump into it. The 3-fund portfolio is exactly how it sounds and is simply made up of 3 funds. One being a total US stock market index, which virtually includes every stock in the US stock market. So that's large cap, mid cap, and small cap stocks, which all in all is over 3,700 stocks. The next would be a total international stock market index, which are companies in both developed and emerging markets, excluding the ones headquartered in the US. And some of them I'm sure you've heard of, like Toyota, Samsung, and Nestle. And the third piece would be a total US bond market index fund. And this includes a variety of types such as short to long-term maturities, and from government bonds to investment grade. The combination of these 3 together is how you form the 3-fund portfolio. Why choose total market index funds? So maybe you already realized it, but the 3 funds that I had mentioned are all types of total market index funds. So you're virtually covering all your bases by being invested in just about every single stock and bond traded in the world. And in these 3 funds combined, you're looking at over 20,000 stocks and bonds all together. So you'll pretty much have all your money invested all across the world. And because of this, you'll get exposure to the benefits and growth of every stock or sector, while at the same time, you're reducing the risk associated with the performance of an individual stock or sector. This simple but powerful strategy also allows you to avoid the need to try and figure out what type of sectors, asset types, and stocks to choose. To top it off, when it comes to the 3 funds that make up this portfolio, there's no overlap between them. So in other words, you don't have funds that hold the same stocks. By having the separation between US stocks, international stocks, and the bonds, you're optimizing your diversification and preventing concentration in just one area. With that being said, let's get into the benefits of the 3-fund portfolio. The first benefit is low cost. When it comes to the 3-fund portfolio, there are very little costs associated with any index funds that make up this portfolio. The reason for this is because the funds are passively managed, so they don't carry the higher cost fees that you'd find with actively managed funds. These fees are called expense ratio, and is charged to cover the costs for the fund's portfolio management, administration, and other expenses. So basically, it's a convenience fee for you not having to trade or pick the stocks yourself. Expense ratios can differ by quite a bit depending on the fund, with the typical range for index funds falling between 0.03% and 0.1%, while some actively managed funds can be higher from 1 or 2% or more. And while even that number may sound small, expense ratio fees can have a huge impact on the performance and returns of your portfolio. To give you a better idea, let's say you had started from scratch and invested $500 a month for 35 years and had a 7% return after inflation. And we wanted to see the difference in results between 3 different fees, which are 0.03%, 1%, and 2%. With the fee of 0.03%, you would have had a balance of $850,000. With 1% fee, it would be $686,000, and a 2% fee, $554,000. With the lowest being 0.03%, that's a $300,000 difference from the 2% and $136,000 from the 1%. Now, I'm sure you'd prefer to keep that difference in your pocket, and that's the great part about this portfolio setup, is that the costs are extremely low. The next benefit is no risk from advisors. Another plus to the 3-fund portfolio is the fact that there's no risk from advisors or fund managers that are handling how your money is invested in a fund. With an advisor, they charge based on how much money is being managed, but it's pretty standard to charge 1% of your total assets under management. On top of that, you're handing over your money and financial future to someone that's incentivized to sell you financial services and products, rather than maximizing the growth of your money. With the thought of investing being complicated and overwhelming for some, it may seem like handing it over to someone else may be beneficial, but the mix of hidden fees, higher cost funds, and the advisor costs can really hinder potential future growth. As for actively managed funds, those are being run by a fund manager or a team who are trying to outperform the market by picking which stocks to buy and sell. So that of course would require a certain level of knowledge and expertise, as you can imagine. But in reality, as history has shown, in the long run, a majority of actively managed funds underperform the market, as the longer the time frame was, the further behind the active managed funds were. While these things can really cut into your returns, the 3-fund strategy will allow you to hold on to more of your money by being invested in index funds that track the market. This leads into the next benefit, which is that it doesn't underperform the market. Unlike the performance and higher cost of actively managed funds, which we had just talked about, index funds won't underperform the market because it's following the broader stock market. So your money is going into a majority of all the stocks and bonds in the world. And to give you a better understanding, an index fund is an investment that tracks the performance of a specific stock market index with the purpose to copy the returns of the market or just a portion of it. And a stock market index is a collection of stocks, bonds, and other investments that are reflective of the entire stock market as a whole, or in other cases, a particular industry or segment of the market. The S&P 500, for example, is an index that tracks the performance of the leading 500 companies in the US. So if you own an index fund that tracks the S&P 500, that index fund buys shares of all the companies that are listed on the S&P 500 index, which in turn, that index fund is going to copy the same movements of gains and losses as the S&P 500. Because of this, the 3-fund strategy will always be in balance with the market and not underperform it. The 4th benefit on the list is low risk. Like I mentioned previously, the 3-fund strategy removes the need for having to pick and choose individual stocks. For this reason, it removes the risk of you trying to research and figure out which stocks will perform well in order to beat the market. We saw that a majority of professional fund managers can't outperform the market over the long run. Then as an average investor, the odds are very much stacked against you. And to add on to that, the broad diversification of index funds also allows them to be such low risk investments. For example, in the case something happened to 1, 2, or a few companies in the index, you're a lot less likely to be affected as much by the negative impacts than if you own that individual stock. The same goes for the many different sectors and industries that you'd be exposed to through the index funds. And the 5th benefit that I say is one of the best is that it's simple. The fact that you're spreading your money into only 3 funds and all you need to do is have money going into your investment accounts on a consistent basis is what makes this strategy so simple. There's no need to worry about what stocks, bonds, or other investments to choose, or spending money on an advisor with the added portfolio risk, and no high fees and costs that would cut into your portfolio earnings. And with the over 20,000 different securities in the stock and bond market worldwide that you'd have exposure to, you won't have to worry about overlapping your investments or having too much concentration in a segment or specific asset. It can be very easy to be misled in thinking that investing is complicated, with what you may hear from the suits on Wall Street or the media. But this investing strategy doesn't require any complicated formulas and spreadsheets. Now that we went over some of the most important benefits of the 3-fund, let's get into building your 3-fund portfolio. Here I'm going to show you a list of index funds depending on which brokerage you have and what piece of the 3-fund portfolio that they make up. And in the case you don't have these brokerages, I'll be showing you some ETFs which you can buy on any investment platform. Starting with Vanguard, when it comes to the total US stock market index fund, you have VTSAX, which has an expense ratio of 0.04% and contains 3,800 stocks. For the total international market index fund, there's VTIAX, which has an expense ratio of 0.11% and holds 8,500 stocks. And for the bond market index, you have VBTLX, which has a 0.05% expense ratio and contains 10,000 bonds. For Fidelity, you'll see I included some extras, which I'll explain why in a moment. So for the total stock market, there's FSKAX and FZROX. For international, there's FTIHX and FZILX. And for the bond market, there's FXNAX. Now, FZROX and FZILX are both part of Fidelity's zero-fee index fund offerings. So these type of funds have a 0% expense ratio and no minimum to invest. But just know that you won't be able to transfer over these zero-fee shares to a different brokerage. So if you wanted to, your only choice would be to sell them since they're only available with Fidelity accounts. Back to the list, we have Schwab, which for the total market fund, we have SWTSX. for international, SWISX, and for bonds, SWAGX. You can see there's some differences, especially between the amount of stock holdings when it comes to the different brokerages. And Vanguard clearly allows you to own more stocks in total, but ultimately the choice is yours when it comes to deciding the brokerage that you'd like to go with. Just be aware that Vanguard does have a pretty high $3,000 investment minimum when it comes to their funds. And in the case you don't have these brokerages, here are some ETF equivalents that you can buy to create a 3-fund portfolio. And these ETFs you can buy no matter the brokerage, whether it's from Vanguard or Fidelity to Webull, M1 Finance, Robinhood, and others. Next would be deciding the asset allocation. So you may be thinking, well, how much of each one of these funds should I buy? Well, asset allocation simply means out of your 100% of your total portfolio, how much are you investing into each segment between your total US stocks, total international, and bond index funds. This is really important to think about because your choices will play a big role in your potential returns and determining your level of risk. For example, if you want to take on more risk with your portfolio, then the more stocks you'd want to hold, which would increase the potential for higher returns. And the less risk that you want to take, then you want to have more bonds, which will have lower potential returns. If we take a look at this table, which shows data between the years of 1926 and 2019 for different stock and bond allocations. If we look at the 0% stock and 100% bond allocation, we can see that over this time period, it only had an average return of 5.3%, with the best year having a 32% return and the worst year being a drop of 8%. While on the opposite end, having 100% allocated to stocks gave an average return of 10%, with the best year of 54%. And the worst year, a drop of 43%. If you're close to retiring, a drop like this could have a huge effect and cause you to delay your retirement, forcing you to wait out on your investments to recover. And if you were 100% into bonds, then the worst you would have had was an 8% drop, but you would have missed out on further opportunities of growth over time by being very conservative with just a 5.3% return. This highlights the importance of what your risk tolerance is, your age, and retirement goals to help you decide how much stocks and bonds you should have in your portfolio. Now that you have an idea of what asset allocation is, let's get into some common asset allocations. So a more aggressive approach would be a 80-20 portfolio, which contains 64% in US stocks, 16% in international stocks, and 20% in bonds. If you're like me in your 20s and 30s, you could be more aggressive and go for a 90-10 or even 100% into stocks, given that you have the advantage of time on your side and you can take on more risk. Next is more in the middle, a moderate approach that consists of an equal weight portfolio. This would have 34% in US stocks, 33% in international, and 33% in bonds. And the last and most conservative approach, with someone being close to retirement, would be a 20-80 portfolio that has 14% in US stocks, 6% in international, and 80% in bonds. Remember, these are just some common asset allocations, and as your financial situation changes throughout life, so will your asset allocation, so you're free to adjust it as you see fit. Next up is portfolio rebalancing. So rebalancing is when you're adjusting the asset allocations in your portfolio back to the original target percentage amounts. And this is something that you're only going to be doing once a year. So to give you an example, imagine you have a 3-fund portfolio with a 80-20 allocation. So that's 64% in US stocks, 16% in international, and 20% in bonds. And it has a total value of $8,000. That would give you the following values for each portion of the fund. Then, to keep it simple, let's say your portfolio increases by $2,000 due to the growth of your stocks. So now the total of the portfolio is $10,000. And from that $2,000 increase, $1,800 was from the US fund and $200 was from the international fund. This would make your new asset allocation now 69.2% in US, 14.8% in international, and 16% in bonds, which is off from your 64% US, 16% international, and 20% bonds, which means you're now more concentrated in stocks than before. So in order to get you back aligned with your original 80-20 allocation, you would need to sell some from your US funds. In this case, it would be $520 from the US, and you'd split the gains in the amount of $120 to the international and $400 to the bonds to put you back in place. Now, keep in mind, selling out of your investment doesn't mean that you're removing the money from your investment account. And the benefit of doing a rebalance in a tax advantage account means you can avoid any tax impact. And if you aren't sure what brokerage account to go with for your index funds, I go through some of the best index funds offered by Fidelity in this video over here. I hope this gave you a better understanding of the 3-fund setup. Also, don't forget to like the video and subscribe for more videos like this. Thanks for watching, and I'll see you in the next one.